Welcome to Accumulation Pro. I'm your host, and today we're diving deep into the crucial topic of stop loss placement in swing trading. So, what exactly is a stop loss, and why is it so important? Well, a stop loss is a predetermined price level at which a trade is closed to limit potential losses. It's a critical risk management tool that helps you protect your capital by preventing significant losses from any single trade. It also allows you to control the amount you're willing to risk on any given trade. By setting a stop loss, you actually remove the emotional element from your trading decisions, preventing you from holding on to losing trades for too long. This also preserves your mental capital, because knowing you have a stop loss in place reduces stress and anxiety, allowing you to trade more objectively. Ultimately, by limiting losses, you free up capital and mental energy to focus on finding more profitable trading opportunities. It's super important to understand that a stop loss isn't just an arbitrary exit point. Instead, it's a price level that, when breached, suggests your initial trade idea is likely incorrect. This allows you to exit the trade and seek better opportunities, rather than, just hoping for a reversal. Now, there are two primary ways to manage stop losses: automated stop loss orders and manual stop loss execution. At Accumulation Pro, we favor manual stop loss execution, specifically waiting until the last 30 minutes of the main trading session. The reason why is because markets can be volatile and prices can briefly dip below a support level or rise above resistance before reversing. Automated stop losses can be triggered by these whipsaws or fake outs, forcing you out of a trade prematurely. Waiting until the last 30 minutes of the trading session allows you to see if the price break is sustained, and if the price closes below your stop loss level with high probability, it's a stronger indication that your trade idea is invalid. So how do you effectively place your stop loss level? The key is to identify price levels that, if broken, would invalidate your trade setup. Some common strategies include using swing lows and highs. For long trades, you would place your stop loss below the last significant swing low. And for short trades, you place your stop loss above the last significant swing high. You can also use support and resistance levels by placing your stop loss slightly below a strong support level for long trades, or slightly above a strong resistance level for short trades. Another strategy is to use the average true range, ATR, a volatility indicator that measures the average price fluctuation over a given period, and it can be used to place stop losses at a distance that accounts for market volatility. Now, let's talk about avoiding stop hunting and liquidity pools. Smart money, such as institutional investors and large hedge funds, often engage in a practice called stop hunting. They manipulate prices to trigger stop loss orders, allowing them to accumulate positions at favorable prices. To mitigate this risk, avoid placing your stop losses at obvious levels and use the average true range, ATR, to determine a stop loss level that accounts for market volatility. To further avoid stop hunting and being caught in liquidity pools, ensure your stop loss is placed below both 2 times the ATR from your entry price and the last significant swing low if you are in a long trade. One more tip is to consider incorporating a stop loss buffer. This involves positioning your actual exit point slightly below your initial stop loss level, creating a more flexible approach to managing trades. A stop loss buffer acknowledges the unpredictable nature of market movements and the risks of relying solely on a single price level for trade exits. By implementing a buffer zone, you create a range rather than a fixed exit point. The size of the buffer can also be adjusted according to market volatility. In highly volatile environments, a wider buffer is typically more advantageous. Just remember to always consider market conditions, adjust your stop loss as the trade progresses, never move your stop loss to lose more, be consistent, and regularly review and adjust your stop loss strategy as needed. So to summarize, remember the importance of understanding and utilizing systematic quantitative trading algorithms with proper stop loss placement. We encourage you to visit AccumulationPro.com to learn more about our cutting-edge trading algorithms that emphasize risk management for long-term success. At Accumulation Pro, we provide a range of thorough trading strategies, indicators, and screeners aimed at helping you grasp the behavior of smart money. Also, read the full article on AccumulationPro.com that investigates the topic in detail, and try out our free simulators available on the website to understand key concepts in systematic algorithmic trading. Thank you for tuning in, and we hope you found this episode informative and engaging.